This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview. Joining us today is Paul Johnson, the CEO of Power Metal Resources. Now, Paul, let me ask you first of all, did you have a pleasant Christmas? It was about to start a new year here.
Yeah, we certainly did. We've been locked down, literally, the family for most of December because we picked up COVID-19, and it spread around all five of us. So the kids are off school. Everyone was locked in the house, and we managed to avoid too much fighting, and then recovered just before Christmas. So that was great.
Okay, good. Well, I'm pleased to hear that it's you've had it and it's gone through the system. That's a good thing. So you can carry on your daily life. So I wonder if I can ask you first of all to perhaps give us just a summary of the year of 2021 for Power. What were the highlights for you? How do you feel the business has progressed?
Well, it's been a pretty disastrous marketplace for junior resource companies in terms of share price. We've always made it a clear point that when the market conditions were difficult, that was our hunting ground to go and build our business, because there's a much easier environment to acquire new opportunities and to do structuring of those opportunities and the corporate work that's required sometimes when the conditions are difficult. So we've really gone for it in 2021 and added, a variety of different elements to the business. I think one thing that's been quite a powerful move in the company is the creation of spin-out vehicles with effectively four packages that are now in the process of getting ready for market listings in London, which is First Class Metals, where we've ended our Hemlo Schreiber interest in, Golden Metal Resources, a package focused on Nevada, the First Development Resources package focused on the Patterson region, up the road, as it were, a fair way up the road from Greatland Gold and Havieron, but similar type magnetic bullseye targets. And then Victoria Goldfields, the partnership we have with Red Rock Resources, with the large land footprint in Victoria. So they are all lining up now to have their own independent listings. If we're successful with all that, we'll have created multiple new vehicles in London, which is a market that has a lot of appetite for junior resource companies, has a lot of money to deploy, and doesn't have a great deal of opportunities. So to be able to create some new opportunities has been great. Exploration-wise, Mark, we've had some knockout of the park successes. We take the Malopo Farms complex project in Botswana, where very large land package. And we did our first drill program, 3 holes, and we managed to hit nickel sulfides and PGMs. And we got up to 1.7% nickel sulfide from the assays so far, which is a phenomenal outcome. Tati project in Botswana, we've accelerated the exploration there, and we've got, we found multiple arsenic, gold, and nickel anomalies, multi-kilometer anomalies. And we moved that project through from initial exploration into reverse circulation drilling in just a few months. So waiting for those results to come back from the labs. But, phenomenal outcome in the early stages of that project. We have so many different things, around the world. So it's difficult to summarize them all succinctly, but we've had bonanza grade silver in British Columbia. We've had high grade uranium out of the Saskatchewan properties around the Athabasca Basin. We've had some great results in Australia with our work there as well, with gold targets defined in Victoria that are now currently being drilled. So it's all go across the portfolio.
Okay, good. Now, there is, of course, an ever expanding and growing portfolio with power metal resources. And perhaps one of the risks with this is companies often tend to run into problems when they grow or grow in size too quickly. Is this a risk that could be for power, and have you considered that?
Yeah, 100% it's a risk for any organization to take on too much. Part of the risk is managed with the deal structuring to make sure you're not fixed in your commitments wherever possible. So you have flexibility, you can walk away. You don't want to walk away from projects, but if you feel the need to, then you should be able to. And that's how I've built pretty much all the businesses I've been involved with in PLC land, as it were, to make sure that the fixed liabilities are low. Uh, the other thing is that if we were building this company just to keep it all in one wrapper, then you could level that potential danger at us far more directly. But we've been building this portfolio to create spin out opportunities, which we just talked about a few moments ago, whilst also building a portfolio for our own internal development. So we've been quite balanced. And I think the last quarter has been quite important for us, demonstrating with the £750,000 pre-IPO financing for gold and metal, one of our spinouts, that our packages that are going through the spin out pathway can actually raise their own money and become self-financing, which takes the pressure off POW. I think more generally, I'm an accountant and I've spent most of my working life in the risk management environment. So I'm very much attuned to making sure that we don't overcommit and make sure that we do have enough working capital to do what we need to do. And we've been prepared to take some decisions along the way that have preserved and built our working capital, including investment decisions. For example, buying into Kavango Resources back in 2020 at the bottom of the market, that's seen a dramatic increase in valuation for us for that Kavango stock. But also raising money along the way when it was necessary, from the market. And even though it was unpalatable recently to raise, we did raise at 1.05 million at 1.75 pence, which gave us what we needed to achieve our business objectives, and to do so without that risk of overcommitting and not having the resource to be able to do what we wanted to do. So we are quite balanced with it, but it's a fair point, and it does mean, and I think we've been quite vocal about this, that there does come a point when you have to slow the acquisitions and feed out the some of the business's interests into these spin outs, get them running independently before we can carry on building the company with new acquisitions. So we are attuned to all that.
Okay. And just sticking on the idea of lots of multiple projects, multiple interests, multiple jurisdictions, and multiple commodities amongst power metal resources, what about as well the ability to perhaps act quickly and shift focus as to where it might be needed any given time? I'm thinking more on, could it be easy to lose track on what is hot now and where to focus the activities in an interchanging business climate?
Yeah, our approach has always been the tortoise, I suppose, rather than the hare, because we've built our business to give us 10 commodity interests effectively, covering everything from uranium through to gold, silver, nickel, copper, cobalt. And what that means is that we are in the market for most of the hot commodities, as it were. And we're pushing all of our project packages forward. So we will catch the wave for most things in our space as a particular area takes off. So recently we had a lot of engagement with the uranium space, with the uranium price increasing, lots of focus on uranium juniors. Well, of course, in London, there's very few uranium juniors that people can invest in. And it was interesting that in a really tawdry and difficult 2021, it was the uranium transactions that seemed to stimulate our share price and volume more than anything else. And so what we've done is we built a package of 412 square kilometers of ground over 7 property packages in or around the Athabasca Basin area. And we've readied ourselves to be a major participant through the UK market in the uranium space when the time is right. And we've pretty much done that for most of the other commodities as well. So we won't necessarily jump hair-like on the latest hot trend and throw everything at it. We'll just gradually and deliberately push all of our business forward, and we'll catch those waves as popularity comes. And of course, the problem is popularity goes as well in a particular commodity. So you can leverage yourself too much against one commodity and find that the market is not there for you 3 to 6 months down the road.
Okay. I'd also like to ask you a bit about financing and specifically on return on investment for shareholders. I want to ask you about warrants, but also about directors rewarding themselves along the way without share price growth. So if we take first perhaps the director remuneration, what can you tell us about that and Power's model to continue to get growth for shareholders rather than financing to pay the bills?
Yeah, it's one of my bugbears. Look, people have to be paid for the work that they do. They need to live, and that's absolutely fair. We are in the entrepreneurial space with the junior resource sector, and you want to think that the directors of a company are properly aligned, to use that phrase, with the shareholders. One way of doing that is by having a large shareholding. And in the case of POW, we have a board of 3 at the moment, and 2 of the directors have material shareholdings. In my case, I hold 75 million POW shares at the moment. And Ed Shaw has a holding as well. Scott Richardson Brown doesn't have a holding. He's our independent director. So that gives us an immediate alignment. The reality is, alongside the shareholdings, we have options and we have warrants. And if you take the number of those financial instruments, so shares currently held, options and warrants, and you add a penny onto our share price, you realize it's a material gain that the directors will make with that 1 penny increase. Now, you put a 10 pence increase in our share price, you see the rather dramatic upside that there is for the directors holding stock and other instruments. So we are definitely aligned. The problem is, Mark, that if you're not aligned with shareholding, then you're receiving a salary, you're being paid for services. And intuitively, that means that your main focus is worrying about whether your company has enough cash to pay you. And that means that the focus isn't on money necessarily for exploration and development of the business. It's on, can my company raise enough capital? And if there is a period of capital raising difficulty in the markets, as we've experienced in 21, then that can often mean that companies accept finance on a horrendous basis. And they do that in part because it's human nature to pay their own wages. And that, I think, is the ultimate conflict. So I think we've got the right balance at Power. We have, modest, reasonable fixed salary levels. We're focused on incentivization. We're issuing options to all the board members and the team at Power. We issue those options at a considerable premium to the market price at the time. And we really just focused more on the equity. Certainly from my perspective as CEO, I'm driven by the equity and the movement in the share price more than anything else.
Okay. And on the warrants then, Paul, what's your view on the warrants perhaps weighing down on the share price, or at least weighing down on sentiment with shareholders?
Yeah, we've raised capital in Feb 19, raised £1 million, issued 200 million warrants. December 19, we raised £700,000 and issued 192 million warrants. And in July 20, we raised £1 million and issued, I think, 210 million warrants. And then, of course, the recent raise raised £1,050,000 and issued 66 million warrants at 3.5 pence. So just putting that recent raise to one side and focusing on the earlier raises, because those are the ones that had the 1 pence, 0.7 pence and 0.75 pence warrants. We got those blocks of capital from the market at a time when it was pretty difficult to raise money on the whole. And that capital was deployed in our business to build our company during very difficult market conditions. And without that money coming in the way that it did, it would have been tricky for us to have built to where we are today. Now, there is a price to pay for that, in that when your price moves up, and our price moved up to 3.5 pence intraday in January 21, so 11 months ago, then people exercise those warrants that are attached to the financing transactions, and they exercise at lower prices than the current market price, and they can hold the stock or sell the stock and make an immediate profit. And I'm sure lots of people sell the stock and make an immediate profit, because in difficult market conditions you kind of grab the cash when you can. Now, the reality is we have burnt through the vast majority of those financing warrants now, and we're in the final run, as it were. In fact, if one excludes director warrants, which I think people accept are less of a perceived threat than general holders warrants, then all the warrants we have left are the July 22 expiry and 0.75p warrants that people might wish to worry about. Now, there's another 7 months until expiry in July 22, and the amount left of those warrants is dramatically lower than what were issued at the start. And I don't particularly perceive them as a great threat to our business over the early portion or the first half of 2022. Most of the other warrants that we have within the business are transactional warrants that were issued at the time of acquisition of various interests, and the vast majority of those are at considerable premiums to the current share price. And then we have the management staff, consultant advisor options that have been issued at various prices, but again, that's kind of people key and integral to the business, so I think perceived as less of an issue for the general investors. The big issue has been in the difficult conditions of 21, the latter part of 21 particularly. It's always a bit frustrating to see warrant conversions coming in at lower prices, and there is an understandable frustration with that, but we are pretty much through that process now. If you look at the amount of warrants that have been converted, exercised, and are gone, and the rest of them, on the whole, are at much higher prices than where we are today. So I think the balance is swinging in our favour now. I would argue the warrant mechanism to finance a good quality business led by a good management team with a good focus on building the company rather than paying themselves a fortune. But I accept that that's a justifiable point of concern. Now, just to make it clear, we are putting out our quarterly business operational update very shortly for the December quarter. And that will provide a full breakdown of all of our financial instruments. It will have everything in it so people can see for themselves where we are.
Okay, excellent. And just finally then, Paul, looking ahead to Q1 2022, can you give some highlights perhaps that investors can watch out for?
Yes, certainly. Well, let's stretch it to April, because that may make things slightly easier in terms of drawing everything in. So say January to April 2022, we're lining up multiple spinouts where you'll start to see the value of these various packages articulated with, we trust, a market valuation. That includes Golden Metal Resources and First Development Resources that Power are pushing forward. It includes New Ballarat Gold Corporation, which is the JV with Red Rock Resources, that we would dearly like to see listed as soon as possible, and also First Class Metals, who are pushing their listing forward and focused on the Hemlo-Schreiber area in Canada. So those 4 events should see some material traction, and we hope full listings in that period in 2022. In addition to that, our exploration projects, most of them have active work underway, and there will be a variety of what I call meaty exploration programs that we're reporting on in the coming weeks and the next couple of months, where work has already been done. We will be launching more exploration programs, including multiple drill programs we expect in the next few weeks, couple of months, where the results will hopefully happen in the January to April period. We are well financed as a business and able to launch programs without worry or concern from a financial perspective. And that financing that was recently completed in November has certainly helped in that regard, taking some of the pressure off in difficult market conditions, enabling us to be gregarious. Our focus has been on acquisition initially in our business, followed by acquisition mixed with exploration in 2021. I think definitely the focus in 2022 will shift more towards crystallization of value, including the spin-outs, hopefully more disposals and corporate events, but also an even more intense period of proactivity with exploration across our in-house projects. Acquisitions, I think, will likely still happen. We're quite eager to build our uranium exposure, and we're looking to finalize the package with First Development Resources, the spin-out vehicle that still, I think, may increase its portfolio a little. But as a business, we want to focus on seeing value out the door rather than just costs in the door through more or too many acquisitions. So yeah, I think we've got a lot to look forward to. We're certainly in a hyper-active phase. We've got a great team, Mark. We've added 6 team members in recent months into the business, well, in 2021 into the business. Geologists, accountants, marketing communications people, business managers. We're putting in place the systems and procedures that are more akin to a very large company than a small junior. We're preparing ourselves to be a large firm, both through our projects and through our approach to business, which is becoming more disciplined and coordinated with the extra team members able to do more work in the company. So for us, it's a very exciting time. People use that word excited. It's as if you come into the office every day and start screaming Yahoo and jumping up and down and banging the desk. And occasionally we do that, especially when the share price comes down. But we are recognizing that what the market needs to see is crystallization. It needs to see value. It needs to see a proper professional organization. If we're going to take this business to 100 million cap and then 250 million cap and then potentially way beyond that, we have to get our house in order, which is what we've been doing.
Okay, well, Paul Johnson, the CEO of Power Metal Resources, thank you very much for your time.
Thank you, Mark.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stopboxmedia.com. Thank you for watching.